On October 26, 2018, three men walked out of a federal courthouse in Lower Manhattan as free human beings. They shook hands with their lawyers, collected their belongings, and disappeared into a Friday afternoon in New York City. No handcuffs, no perp walk, no prison sentence waiting for them. Behind them, in that courtroom, sat the evidence of a scheme that had extracted an estimated $3.2 billion from the global financial system over the course of a decade. $3.2 billion. That is not a typo. That is the number regulators and plaintiffs' economists attached to the profits generated by a small, exclusive group of currency traders who had, by every reasonable definition, rigged the largest market on planet Earth. And the three men who sat at the center of it, Richard Usher, Rohan Ramchandani, and Christopher Ashton, walked free. This is the story of how they did it, how they almost didn't get caught, and how, in the end, they got away with it. To understand what these men built, you first have to understand the world they operated in. The foreign exchange market, Forex they call it, is the biggest financial market that has ever existed. Every single day, more than $4.7 trillion changes hands in this market. Trillion, with a T, every day. Currencies are traded in pairs, euros for dollars, pounds for yen, francs for sterling, and the price of each pair moves constantly, second by second, driven by central bank decisions, geopolitical events, trade data, and the raw force of supply and demand. It is a market so vast, so deep, so liquid, that for decades the people who ran it operated under a single, comforting assumption. They believed it was too big to manipulate. Nobody could move a $4.7 trillion market. Nobody could corner it. That belief was the foundation everything else was built on, and it was about to be proven catastrophically wrong. The men at the center of this story were not born into this world. They climbed into it. Richard Usher was a senior trader at the Royal Bank of Scotland, one of Britain's largest banks, before J.P. Morgan Chase hired him in 2010 to run their spot foreign exchange trading desk in London. Spot trading means buying and selling currencies for immediate delivery, not next month, not next quarter, right now, at the current market price. It is the rawest, fastest, most visceral form of trading there is, and Usher was one of the best in the world at it. Rohan Ramchandani took a different path. He graduated from the University of Pennsylvania, one of the most prestigious universities in the United States, with a degree in economics, and then climbed the ladder at Citigroup until he became the head of European spot trading, the man responsible for every euro-dollar trade Citi executed on the continent. Christopher Ashton ran the voice spot trading desk at Barclays, the 300-year-old British banking giant. These were not junior analysts. These were managing directors. They sat at the absolute apex of a global trading hierarchy, and together they controlled a staggering percentage of the world's daily currency flow. But here is the thing about being at the top. It gets lonely, and it gets boring. When you trade currencies every day for a living, you start to notice patterns. You notice that certain things happen at certain times, every single day, with mechanical predictability. And the most important thing that happened every day in the entire Forex market was something called the fix. At 4 o'clock in the afternoon London time, that is 11 in the morning in New York, a benchmark rate is calculated. It is called the WM/Reuters 4 p.m. fix, and it is the single most important number in global finance that you have probably never heard of. Pension funds use it to value their holdings. Mutual funds use it to price their portfolios. Index funds, more than $3.6 trillion of them, use it to calculate what their investments are worth at the end of every single trading day. Trillions of dollars are settled at this one price, calculated during a single 60-second window, once a day, every day. And the people who set that price were the traders, the very same traders who stood to profit or lose, depending on where it landed. Do you see the problem yet? Here is what the fix actually was, mechanically. During that 60-second window, from 3:59:30 to 4:30 London time, the banks would execute all of the client orders they had accumulated throughout the day. A pension fund in Manchester wants to convert £100 million into euros. A mutual fund in Boston needs to move $200 million into Japanese yen. An asset manager in Zurich has to rebalance a portfolio worth $500 million. All of these orders, billions and billions of dollars worth, would pile up on the desks of the spot traders throughout the day, and then, in that 1 minute, the traders would execute them. The average price achieved during that window became the fix. The fix became the settlement price for the entire global market, and the traders knew, hours in advance, exactly how much they had to buy or sell. They knew the direction. They knew the volume. They knew what was coming. And what they did with that knowledge was this. They picked up the phone, or rather, they opened a chat room, a private, invite-only electronic conversation that they called, with a straight face, the cartel, not a nickname given to them by journalists or regulators. That is what they called themselves, the cartel. Richard Usher, Rohan Ramchandani, Christopher Ashton, and a rotating cast of perhaps a dozen other traders across JP Morgan, Citigroup, Barclays, Royal Bank of Scotland, UBS, and HSBC. They communicated through encrypted chat clients and Bloomberg terminals, exchanging information that was never supposed to leave their trading floors. They shared client order flow. They told each other what they had to buy, what they had to sell, how much, and when, and then they coordinated. The mechanics were simple once you saw them. When a trader knew that a massive client order was coming, say, a pension fund needed to sell 3 billion euros and buy dollars, that order, by its sheer size, would push the euro down against the dollar during the fix window. If you knew that in advance, you could sell euros ahead of the client order, front-running it, and then buy them back at the artificially depressed price the client's own order had created. You were picking the pocket of the very client who trusted you to execute their trade. The bank's own clients, pension funds, mutual funds, the retirement savings of ordinary people who had never heard of Richard Usher or the WM/Reuters 4 p.m. fix, and never would. They did this every single day, for years. The Department of Justice would later estimate that this small group of men controlled a combined daily trading volume so large that during certain currency pairs, they could move the price of money for the entire planet. And they did. Banging the close, they called it flooding the market during that 60-second window to push the benchmark in the direction they needed. They joked about it. In the chat logs later recovered by regulators, they used language so casual, so bored, so utterly devoid of conscience that it read like a technical manual written by people who had forgotten they were stealing. One trader wrote that he was going to double-team a client order with a counterpart at another bank. Another simply typed 3 letters, FUD, which stood for fully used and disclosed, a sardonic code meaning he had extracted maximum advantage from a client relationship. This went on for years. From roughly 2007 through 2013, the cartel operated with near total impunity. Nobody asked questions, nobody internal compliance, nobody external regulator, nobody in senior management raised a hand. Why would they? The desks were generating hundreds of millions in revenue. The banks were winning awards for their foreign exchange divisions. And the losses were distributed so widely, a fraction of a cent per trade, across trillions of dollars, across millions of savers, that no single victim would ever feel the knife. That is the genius of the scheme, and also its horror. The theft was real, $3.2 billion by conservative estimate. But it was stolen 1 basis point at a time, from pensioners in Manchester and schoolteachers in Ohio and factory workers in Osaka, none of whom would ever know that the price they got on their currency conversion had been nudged a hair against them by a man in a London tower sending a chat message to a man in another London tower. The perfect crime is not the one where nobody notices. It is the one where the harm is so distributed, so atomized, that it becomes invisible. They almost got away with all of it. What brought them down was not a whistleblower, it was not investigative journalism, it was an accident. Regulators investigating the LIBOR scandal, a completely separate manipulation of benchmark interest rates, stumbled onto a second universe of benchmark rigging in the currency markets. The chat logs were sitting right there. The banks, desperate for leniency, handed over everything. HSBC, JP Morgan, Citigroup, Barclays, Royal Bank of Scotland, UBS, bank after bank fell in line, paying cumulative fines that exceeded $5.6 billion. The banks paid. They always pay. That is part of the design. But the men? The men who typed the messages, who coordinated the trades, who named themselves the cartel, and joked about it in writing? On October 26, 2018, after a trial that lasted barely a month, a federal jury in the Southern District of New York acquitted Richard Usher, Rohan Ramchandani, and Christopher Ashton of all antitrust charges. They walked out of that courthouse into the Manhattan afternoon, and they were free. The jury's reasoning was not unreasonable. The defense argued that sharing information about client orders was common practice in the industry, that every bank did it, that it was simply how the market functioned. And in a narrow, technical, legal sense, the prosecutors had failed to prove beyond a reasonable doubt that these specific men had crossed the line from aggressive trading into criminal conspiracy. The law, as written, did not quite reach them. The law almost never does, at that altitude. And here is where the story stops being about three men in a courtroom and becomes about something much larger. Here is the thesis. Richard Usher, Rohan Ramchandani, and Christopher Ashton did not get away with it because they were innocent. They got away with it because the architecture of global finance is constructed in such a way that the people who sit at the nodes, the managing directors, the desk heads, the men with access to the flow of trillions, are insulated by layers of institutional abstraction that make individual prosecution nearly impossible. The bank pays the fine. The fine is a balance sheet entry. The cost is passed to shareholders. The shareholders are pension funds. The pension funds are the very people who were stolen from in the first place. Do you see the loop? The victims pay for the crime. The perpetrators retire. Richard Usher left JP Morgan in 2015. Rohan Ramchandani was fired from Citigroup in 2014. Christopher Ashton left Barclays in 2015. None of them went to prison. None of them forfeited personal wealth in proportion to what was extracted. The banks that employed them absorbed $5.6 billion in fines as a cost of doing business, and the traders, the actual human beings who typed the words, who made the calls, who named themselves the cartel, dispersed back into the financial industry, into consulting roles, into quiet early retirements, into the same class of wealth they had served their entire careers. This is what financial justice looks like when the perpetrators are powerful enough. Not a cage, not a perp walk, not a reckoning, a settlement, a number, a press release, and then silence. The system is not broken. That is the part that is hardest to accept. The system is functioning exactly as it was designed to function. It is designed to protect the flow of capital above all else, and when the people who control that flow commit crimes, the mechanism absorbs the damage, distributes it downward, and continues operating. The banks are still standing. The Forex market is still the largest on Earth. The 4 p.m. fix is still calculated every day. The only thing that changed after 2018 is that a few chat rooms got renamed. The lesson of the cartel is not that crime does not pay. The lesson is that crime pays extraordinarily well when you commit it at a high enough altitude, inside institutions large enough to absorb the consequences on your behalf. $3.2 billion was taken. Nobody went to prison. The men who took it are free. The people it was taken from never knew it happened, and they never will. That is the story, not of greed, not of ambition, of structure, of a world where the distance between the people who move the money and the people who own the money is so vast, so carefully maintained, that accountability simply cannot cross it. Remember that. The next time someone tells you the markets are free, the next time someone tells you the system is fair, the next time someone tells you that justice is blind, remember the three men who walked out of a courthouse in Lower Manhattan on a Friday afternoon in October, free, wealthy, and unmarked, having rigged the largest market in the history of human civilization and gotten away with every single cent of it. The market is not free, the system is not fair, and justice, when it comes to the people who actually run the world's money, is not blind at all. It simply looks the other way.